Well, for more on the GDP data, we're joined by Alejandra Grindal, chief economist at Ned Davis Research. She joins us right now. Alejandra, thank you a lot for joining us. I'm just going to reread these numbers. Gross domestic product on an annualized basis in the fourth quarter comes in at 3.2%. That's down from the earlier print and from expectations by a tenth of a percentage point. 3.2% reported, 3.3% expected. Personal consumption rises by 3.0%. The GDP price index rises by 1.6%. Both of those numbers are stronger than expected. What's your takeaway from these numbers, and what are they telling us about the path of the U.S. economy?
Yeah, thank you for having me. So there were some slight revisions to the data, but nothing huge. I think it still maintains the same story that we saw with the first release, that real GDP in the United States ended 2023 with above trend growth, above potential growth, which we estimate at around 2.2%. So still a very strong reading. We're still seeing signs. You mentioned the upward revision in the consumer. The consumer remains strong. That's been the story of 2023 and likely to continue in 2024, although slightly less so, sort of falls in line with our soft landing scenario. And then still continued disinflation. Yes, we saw a slight upward revision, but the path is still in the right direction. So ending the year strong. I think one thing to point out about the GDP data, however, is it's, past looking, right? So it's just ending 2023. And so the big focus now is, ultimately what's going to happen this year in 2024.
Alejandra, the economy has generally just held up so much better than people expected from 12 months ago. It's almost amazing from a U.S. data perspective. Looking forward into 2024, the rest of this year, where do you land from a probability perspective that will just simply outright avoid the weakest patch or the technical recession argument that many people have been saying for the last 18 or 24 months?
It's a great question. So our, number one scenario for this year is a soft landing. In fact, we had a slight probability of recession possibly happening in the United States, but I think now that has dissipated, and now the notion of a no landing scenario has now sort of come up, but soft landing seems more likely. So if you go back and you look at why 2023 was so resilient, again, it goes back to the consumer. Very different from 2022. We actually saw an increase in real wage growth. So that sort of maintained that purchasing power. That was that combination of disinflation and strong job market. Another big change we saw is household debt service ratios remained fairly low because so many households locked in low mortgage rates. And there was also excess pandemic savings. Now, going into this year, those elements will still provide support to the U.S. consumer, but slightly less so. Job market is still strong, but we're starting to see those, extreme imbalances sort of stabilize a little bit, so it won't be quite as strong as it was last year. Excess pandemic savings will at some point likely be exhausted sometime this year, maybe by the second half of the year, so that boost won't be there either. But the fact that we're still seeing disinflation and we'll likely continue to see positive wage growth, I still think that'll continue to support the consumer in 2024, just not quite as much as last year.
Let's talk a bit more about the jobs market in the United States. You characterize it as strong. It's frequently headlines today, and there's another one today, Bumble, which is a dating app letting go a substantial number of employees. We hear these reports. How do we square these reports of large job cuts, 350 at Bumble, and there's been other larger numbers as well, with the aggregate numbers in the U.S.? How strong is the U.S. market? Are these layoffs that we hear about material to the job picture?
Yeah, I mean, anytime you hear about layoffs, obviously we need to be watching the data. It does turn our attention. Challenger, Smith & Gray, they come up with layoff data every month. We'll get a February reading fairly soon. But in January, there was actually a pretty strong number. But there tends to be a lot of volatility and seasonality to those numbers. And if you just looked at it on a smooth basis, layoff trends still aren't that bad. They're still below their long-term average. It's also important to see where the layoffs are coming from and why they're happening. So you mentioned the dating app. We've seen other layoffs from large tech companies. Tech companies did really well during the pandemic, and they hired like crazy, and perhaps it was overdone. So a lot of the layoffs we're seeing recently tend to be a little more on the tech side. And if they cite their reasons, a lot of it is not so much due to economic reasons, but it's due to, cost cutting or restructuring. So perhaps a little different. So I think this is a bit more of a structural change. And then in terms of, the impact on the broader jobs market, we tend to look at all the data, right? So we had a pretty strong jobs report in January. Jobless claims remain extraordinarily low. I mean, near record low levels. So, these people who are perhaps losing their jobs are either able to find a job relatively quickly, or they're receiving severance packages, so they don't apply for the claims, but that's still keeping them going until they can find that right fit. So far, we're just not seeing any major signs that these layoffs are having a huge impact on the job market when you look at the broader data. But like any data, we'll be watching it closely.
That's great insight, Alejandra. Just very quickly, because we're out of time, what is your call on the U.S. Fed? When does it make its first rate cut, and how many cuts will we see in 2024?
The golden question, right? So I'm looking at first rate cut in June, and now sort of looking at around 3 cuts this year.